Now, tell me something within this. I have another, much more finance kind of a question. If we look at the shareholdings of these companies, if we look at it, and traditional Indian companies जो list होती है, if you look at the JSWs of the world or the Tata Steels of the world, it's much more promoter driven, promoter backed. Or we're not even talking about the groups. Let's look at Adani also. The Indian ecosystem of the markets is much more promoter driven. But where we have these, when we have these, tech companies coming into play, their promoter percentage is less than 2%, and this is the same concept which is in the West, where it's much more PE based, PE backed, VC backed, sovereign fund backed. How do you see this culture evolving? Because now there are so many companies that are wanting to list these tech enabled companies. How do you see that culture changing, or and do you see any perspective from a fund manager's point of view changing? Because now that there are you know much more, I'm not going to say, so I think the better word would be people from our community, finance community, which is fund managers, being part of that board which is taking calls. So how do you see that entire structure changing of looking at a company as a whole?
So it's interesting, and there are kind of pros and cons. Firstly, in terms of why the structure, right, where promoters own very
Yes.
small percentages of the overall company. I think this needs to be looked at the context of the kind of sheer hyper growth that these companies have and the kind of hyper growth these companies have been able to deliver. What you have seen is that across kind of digital platforms, you've actually had companies build in years what has taken traditional businesses decades to kind of build out, right? And we've
Yes.
got some of this in our kind of we've got some of this in our pitch deck. If you're seeing Paytm when they launched their kind of lending business, they
Right.
actually in 2 years were dispersing as much as an SBI cards, and SBI cards took 25 years to build out that level of scale. They
Insane.
were actually in the second year of their loan dispersal, were dispersing more than City Union Bank, which is a century old financial institution. You've seen this. This is not just a PTM, right? You've seen this with a Nika. You've seen this with a delivery. You've seen this with a Zomato. The kind of what these digital platforms are really doing is using institutional capital to significantly shorten the time it takes to build a large scalable business. And we are talking about crunching what takes decades and decades down to a few years.
Hmm.
Now, in order to do this, the promoter does really have to actively dilute because before you become a multi-billion-dollar company, you are sitting trying to go out and raise a few $100 million, etc. That can only come if you are diluting. But what this does actually enable is that most of these companies have been able to professionalize significantly earlier than your traditional kind of promoter businesses. There are still businesses that we evaluate today in the non-tech space that even 40, 50 years down the line still are extremely promoter dependent. And these companies, even 40, 50 years into their maturity, really struggle to professionalize. The one big positive with most digital tech firms is that the level of professionalization that we see tend to mirror that of really large companies. And this does actually reduce some of the risk of a bad promoter.
Hmm.
That said, you also lose the kind of charm of a really high quality promoter.
Hmm.
Sometimes if there's a really high quality promoter with significant skin in the game, driving the overall business, may believe that that promoter has a greater ability to drive long-term value than say a professional. With a high quality professional, there's always a risk of that professional getting poached, and then you have to
Hmm.
find other high quality talent. We really look at this in terms of both the pros and the cons. We are very well aware that the promoter does not have significant skin in the game, but for most companies that we consider as part of the portfolio, these are companies that we believe have been institutionalized to a level that even if the promoter were no longer around or no longer actively involved in day-to-day management of the businesses would actually continue to run perfectly fine and continue to scale the way they are.
Interesting, interesting. So how do you see that culture change then? Tomorrow, more companies. So this will act as an enabler and a multiplier effect. And more companies would want to do something like this, where they scale fast, they dilute fast, and then they list fast. Is that something that you see? But at the end of the day, is the stakeholders of the which are the investors, would not. I'm not talking about the insti ones, but I'm talking about the ones who do not fall into the shareholding pattern. won't they be the one who would be slightly at a, cliff where at the end of the day, it's the greater fool theory, right? You're passing the buck to the next person. So don't you think so at that there'll be a point where stakeholders are at risk, where they are holding something that is much more expensive than it actually should be, and just become an, long-term investor, quote unquote, till the profitability comes, if you get what I'm trying to say.
You know, Sujit, I get exactly what you're trying to say, right? And if you just look at the kind of the venture capital funding ecosystem over the
Right.
last 5 or 7 years, it had gone crazy, right?
Hmm.
There were HNIs and ultra HNIs that I believe had absolutely no capability of doing unlisted transactions. They
Hmm.
had no ability to assess the deals, legal due diligence was compromised, all kinds of just basic hygiene checks that
Hmm.
even a basic institutional fund would do, right? You were significant sums of money were getting invested in unlisted without any of that happening. Uh, it is important to understand that, from the position where I'm sitting and the fund I'm managing, the AMI Digital Disruption Fund, this is a listed digital platform. We are actually having the ability to choose amongst what we believe to be the winners. But the
Right.
simple reality is that when you're looking at the digital tech space and you're looking at the startup ecosystem, there is a extremely high failure rate. The
Hmm.
last decade, because of a certain level of what I believe to be almost mania around kind of unlisted transactions, valuations have gotten crazy, and people were no longer focusing on building businesses. People were focusing on raising this round of capital and being able to demonstrate value creation to be able to raise the next round at a higher price. There were
Right.
a lot of businesses coming in without unit economics being clearly established, without the path to profitability being clearly established, right?
Right.
Without the competitive barriers to entry, the particular company's right to win. Or, there's a tremendous amount when you look at companies like a Zomato, a Paytm, a Nykaa. These are companies that have been able to kind of go through significant challenges and actually emerge victorious. And our fund really just bets on piggy banking on these victorious kind of these companies that have actually been able to scale, do very well, and where we believe there's still a tremendous amount of scalability going forward and still a
I
lot
think
of
this is
growth.
where we were talking about.
But
Sorry, please go ahead. I was just trying to
yeah,
add
go
some.
on.
So thing is, I was just trying to add to something that you said. This is where we were also speaking, the other day, where we have to model till FY32, and that is where we look at the company and then, really look at it from a 6-year perspective for the profitability and then discount it back to its value today. Isn't that another way to, look at things? Just wait it out because the profit is not there.
No, so see, yeah, no, but what happens is that the 9 out of 10 companies may not achieve that profit.
Right.
Right. So you have to be very, very clear. So we've got a very, very rigorous kind of a fund selection methodology
Hmm.
at kind of for the IME digital distribution portfolio. There are specific, like, so just kind of one, we want to be very, very clear about the longer term scalability of that particular opportunity. There needs to be that evidence of dominance. Most digital platform businesses will kind of move towards a tight duopoly, 2 or 3 or 4 player ecosystem. And this is
Right.
because naturally platform businesses, participants on the platform all gravitate towards where there is scale.
Hmm.
You want to ensure that you are going to be one of those winners. So if you're looking at a kind of a fund selection methodology, that evidence of domination, the large addressable market, the path to profitability being very evident, and evidence of kind of optionality to add on new business lines to kind of create incremental value. These are all extremely important. There are about 25 to 30 companies that are listed today that kind of form what kind of we would call digitally native, digital first platform businesses. Only about 7 of them meet these criteria, right?
Okay.
So when I'm saying we are sitting and we are building long-term models and we are kind of assessing profitability going into FY30, FY32, you can do that for companies where you have that confidence on the growth on the path to profitability. And importantly, the competitive barrier to entry that prevents someone else coming in and actually stealing the opportunity that you work so hard for.
Hmm. Mm-hmm.
The only way, according to me, to value a company, and we were also discussing this the other day, right? That people look at price to sales or price to users or different kind of
Correct.
metrics to sit and try to assess the value of a company that doesn't make profits as of today.
Right.
All of these are basically just de facto alternatives for a traditional PE, a traditional kind of a profit-based multiple. And
Mm-hmm.
whenever you are using such a metric, it always has to go back to some back of the envelope calculation of what do you think the inherent longer term profitability of that business is. So, for
Right.
example, when Swiggy or Zomato, so say, for example, when a Zomato went in for an IPO, right, and they were probably trading at about 10 times price to sales. If you
Correct.
believe the longer term EBITDA margin on that business is about 20%,
Right.
uh, I may be saying, okay, I'm buying it at 10 times sales, but at the back of my head, you're like, okay, fine, if sales is a billion and therefore $200 million is the potential longer term EBITDA on this level of sales, you're actually paying the equivalent to 50 EV EBITDA at the time when it turns profitable. And then you're really focusing on two elements that one, what is the level of confidence that you have that these companies are going to turn profitable, right? Because a lot of these are things you're trying to forecast into the future. And secondly, then for that level of kind of profitability, what's the level of valuations that I'm paying? And by buying in today, am I going to be able to kind of create value over the longer term?